Greg Epp, let's talk to what you're thinking about this, the actions you've seen from the Fed, and what you're hearing about the market potential problems at this point.
Well, I think what the market is basically telling you is that they know that the Fed is out of bullets, at least of traditional monetary bullets. I mean, the market responded very badly to the first half-point rate cut. They've responded badly to this full percentage point rate cut, and that's not the fault of the Fed. It's basically the Fed has used up whatever conventional ammunition it has, and it's not even clear that that ammunition wasn't well calibrated to the type of problem we're having here. That said, I think what the Fed has done in terms of the liquidity stuff and the promise to be the buyer of last resort on Treasury and MBS will keep things from getting worse. It's basically the Fed's traditional lender of last resort function. It's going to keep the economic crisis from becoming a financial crisis. But like Steve said, I think we're going to have to see how the markets actually behave and the way the Fed actually implements this plan to see just how quickly it's going to have the desired effect.
Hey, go ahead, Becky.
No, go ahead.
I was just going to ask Greg, you covered the financial crisis, and we've been talking all about the measures that the Fed has been taking and may be able to take in the future. But one of the things we just talked to Peter Navarro about, and clearly one of the issues that is cropping up, given that Stephen Mnuchin is talking about bailout powers, is what you think the Treasury may ultimately need to do when it comes to both industry, big industry potentially, and also small businesses, to the extent that there's an opportunity to provide a bridge loan, which might be a very complicated thing to do, but conceptually is what may be necessary.
Well, I think there's a lot they can do, but they're going to have to make a tough decision on how they help two different classes of companies. Those that are just illiquid, they're solid businesses, but they have a 1 to 2 month cash flow problem. That's where things like the Fed's commercial paper facility can come in. They're just overcoming the reluctance of the market to provide funding. The bigger problem is companies that are potentially insolvent. Their business is going down because they're essentially getting no revenue for the foreseeable future. That's a much tougher call. The model you want to look for there is the airline bailout that we had after 9/11. Congress passed $5 billion in cash assistance and $10 billion in loan guarantees, which are administered through a board that included the Fed chairman. So I don't know exactly what they'll come up with, but there needs to be a sort of a mechanism that makes that distinction. One of the problems you're dealing with is those things take time to get in place. The Fed can probably move relatively quickly to create something like the commercial paper facility, but establishing these sort of like bailout mechanism is going to be tough, and there's going to be a lot of criticism and second guessing about whether you're throwing good money after bad and whether you're bailing out Wall Street and corporate America instead of the working family.
Anastasia, what are you thinking this morning?
Well, absolutely spot on what Greg has said is that the missing piece of the puzzle here is this fiscal response and providing assistance, maybe with some credit facilities to the businesses that are going to be impacted by the containment measures. But the reality is it's going to take time, and maybe it's a few days, maybe it's a few weeks, but it's going to be some negotiation to get there. So from a market perspective, the action that we're seeing today and we've been seeing, we could see more of those plus or minus 5% or even 10% down days, because it's going to take time for the policymakers to come up with the adequate response. Having said that, I think they will ultimately get there, and the testing helps. The Fed stimulus package absolutely helps. But we really need to see something closer to a $500 billion overall fiscal package from the federal government to really provide the offset to this economy. It needs to be sweeping and it needs to be comprehensive, and thus far we've not seen it yet. So definitely some patience will be required in the markets in the meantime.
Hey, Steve, again, this is moving pretty quickly. We're not talking day by day. We're talking hour by hour and maybe more quickly than that. What should we be watching as we get closer to the opening bell? What are you hearing back from all of these market participants you're talking to?
I think we have to see how some of these spreads trade. I will say there's some consternation about the Bank of Japan. Some of the Japanese banks, it's my understanding, have withdrawn from some of the dollar funding markets. And they were hoping for better guidance from the BOJ to urge banks to use the dollar swap lines. That did not come, so there's concern in that regard. We're going to have to watch how commercial paper trades. We're going to have to watch how the different treasuries trade versus derivatives and versus the on the run and the off the run. I will say one thing. I don't want to be too optimistic here, but Andrew and I have been having sort of a running discussion about the difference between what's happening now versus the financial crisis. As far as I can tell at this point, it may be one very good sign here that we do not have bank solvency problems. That was a huge issue in the financial crisis. And as far as we know, the banks are well capitalized. Indeed, one of the issues out there right now is the Federal Reserve trying to get the banks to use what liquidity and capital they have. It was a very interesting statement last night that the Fed put out, which basically said, as you get closer to your liquidity coverage ratios, we are not going to penalize you. Banks are very concerned because of the Dodd-Frank and the liquidity ratios that were put in place, that if they get close to those ratios, that they'll be penalized by the Fed. There is capacity out there on the part of the banks because there are not solvency issues to help this problem, and we'll see if the Fed is effective in getting the banks to step up.